Welcome back to Primetime Morning. Now, it's been a roller coaster ride for global markets last week. Mounting signs that the U.S. economy is slipping into a recession have renewed global inflation fears. To give us his views on the global economy, I'm now joined by Leon Perera. He's Group Managing Director of SPIRE Research and Consulting in Singapore. So, Leon, with a looming U.S. recession and high commodity prices, your outlook for the global economy?
Well, I think there's no doubt, Jennifer, that the global economy is heading to a downturn. The U.S. is clearly in a recession. I think that's the consensus among the community of analysts and economists, and global commodity prices are at record highs. West Texas Intermediate was last trading at $101 a barrel, which is a record high. Wheat prices are at record highs. So I think in this context, what we see happening in the global economy is actually more of a slowdown rather than a meltdown. There's no doubt that the U.S. is the largest economy in the world, accounting for roughly 30% of global GDP in exchange rate terms. Moreover, I think the Eurozone and Japan are looking lackluster, and growth in both of those two areas may come in at under 2% going into the first quarter. So we're looking clearly at a downturn. The World Bank is forecasting 3% global GDP growth this year, as opposed to about 4% in 2006. We in SPIRE would expect global GDP growth to be a little under 3%. But on balance, I don't think the world economy is heading into a recession or a meltdown. And the main reason for that is that the U.S. accounts for a smaller share of global GDP than it used to even, say, 10 years ago. And I think on the upside, we have the Asia-Pacific region and other emerging countries which continue to show robust and broad-based growth. Let's not forget that since 2001, the Asia-Pacific has accounted for more than half of global GDP growth, and China and India continue to grow strongly, largely driven by domestic factors, and other emerging markets such as Brazil and Russia should not be ignored as well. Both Brazil and Russia have economies of roughly about $1 trillion US each. Russia may be entering the WTO this year, and that may help to actually feed the results of Russia's energy boom into the global economy. So basically, yes, a downturn, but no meltdown globally.
Okay, from economies, let's now go to the markets. Asian stock markets have been volatile since the start of this year. How do you advise your clients on how or where to make their investments amid these uncertain times?
Well, I think when we look at the investment outlook, the most important thing to state is that there are reasons to be bearish on global equities. And I think some of those reasons have nothing to do with what's happening in the U.S. Global equities saw a bull run from about 2005, and that is now going through a downward correction. I think on top of that, we have the seasonal or more topical factors. I think if you look at Asian equity prices, these tend to be influenced very much by the news from Wall Street, and by the news, to a lesser extent, by the news from China and Hong Kong. And I think bad news will be coming from both those sources for quite some time. I think the equity data from Wall Street is going to be fairly negative, at least for the next 2 calendar quarters. And I think when we look at China, there is a correction in the prices of China A shares that has already begun to take place, and that's going to continue to play out, I think, in the first 2 quarters at least of this year. That's going to affect Hong Kong prices, and that's going to dampen Asian equity prices. So in general, I think equities are a somewhat dangerous place to be right now. I think for companies with cash reserves and for individuals looking to invest, I think the best bet would really be to invest in financial instruments that are linked to commodity prices, energy, but perhaps more importantly, agri-food commodities and precious metals and base metals. I think high commodity prices are going to be here for quite some time. The rate of increase may not be as high. There will be some slackening in the rate of increase due to what's happening in the global economy and the U.S. economy. But I think fundamentally commodity prices are going to increase across this year and probably into next year because of very fundamental demand and supply imbalances. Particularly when we talk about agri-food, I think the populations of China and India have passed tipping points where incomes have led to people switching to eating more meat rather than vegetables, and that's actually driving the prices of agri-food commodities. So basically that would be the place to look at.
Okay, so we'll take a note of that. Commodities-related investments are really hot right now. Moving on, investment banks have raised their forecast for Chinese inflation for this year to 6.8% from 4.5% previously. Do you expect more tightening measures from the Chinese government?
Well, Jennifer, there'll certainly be more tightening measures. I think last year was a story of the China government implementing many tightening measures. They raised the interest rate or the deposit rate 6 times. They raised the reserve requirement rates 11 times. And I think going forward, we don't expect so much in terms of interest rate increases this year, because the issue there, I think, is that the more the China government raises its interest rates, the bigger the gap becomes between China interest rates and US interest rates, and that puts pressure on the RMB to appreciate, and the China government doesn't want that to happen because it doesn't want exports to be affected. I think what we'll see from the China government to control inflation will be continual increases in reserve requirements on banks, and maybe some command and control measures to rein in the growth of loans from the big 4 state banks. But I think the most important point to note is that we don't feel that this will have a major effect on inflation. Last year, the reserve requirements raised 11 times. Inflation was still very, very high. We don't think that these measures will bring inflation back down to 1% or 2%, which is what it was really before last year. And I think part of the reason...
Leon, sorry to cut in, but since we're running out of time, I've just got room for one more question. Let's go to currencies. The dollar remains under pressure this year, and in fact, the Singapore dollar surged to a fresh 10-year high versus the US dollar. So what does this mean for regional economies?
Well, I think the weakness of the US dollar is definitely a big story. We don't see a major meltdown in the value of the US dollar. We think the G7 economies will step in to make sure that the value of the US dollar against global currencies and therefore Asian currencies will remain somewhat stable. But I think it will definitely have its effects. I think in Singapore, we expect the manufacturing sector to be affected more on the electronic side. I think for chemicals, petrochemicals and biomedical, the demand is less elastic. I think financial and business services in Singapore may be affected. Some of their revenues are in US dollars. There are many US companies in that sector, and they're also being hit by very high commercial property prices. I think in the rest of the region, the impact of a weak US dollar will be mixed. More negative effects in countries like Singapore and Taiwan. ASEAN will be moderately affected, and I think China and India will be less affected, as most of their growth is really domestically driven.
Thanks very much indeed. Leon Perera, an economist and also Group Managing Director of SPIRE Research and Consulting in Singapore. From the Business Desk, I'm Jennifer Alejandro.